Welcome back to another episode of Not Financial Advice. My name is Sean. Today is Wednesday, March 13th. We're approaching the end of the trading session. And today we're going to be talking about Williams-Sonoma stock. So the stock is up over 18% today. I've made about $380 on this stock today, up 18% after a strong quarterly result. And so getting into Williams-Sonoma, I'm going to show you at the end of this video what I think it's worth per share and whether it's a good investment now or not. But we're going to jump into that, and I'll show you what I think the stock is worth per share right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Right, so I'll ask you to like the video and subscribe to the channel. And what I'll say to you is that the best mutual fund manager of all time is named Peter Lynch, and he made a lot of money off of Spanx or leggings for women. And for what it's worth, investing is a pretty male-dominated arena. I don't think that's great. I'd love to be part of changing that. At the same time, any stocks or companies that are feminine or loved by our wives, girlfriends, mothers, sisters are, I believe, overlooked by Wall Street. And so Peter Lynch made a lot of money on Spanx, and I'm making a lot of money on Williams-Sonoma. So that's the premise. And if you're not familiar with Williams-Sonoma, it's a ritzy store for upper middle class ladies to buy $300 French cast iron skillets. And so my investment thesis on it is that women drive the majority of consumer spending and decisions in the United States, and those who are upper middle class or wealthy will continue to spend independent of any economic condition. And so that's why I own this stock, and I've owned it for a long time. So I have about $2,500 of value in this stock. It's up right around 18% today. And, the thing that's cool about that is the market is down today a tenth of a percent. It's down about a tenth of a percent, but my portfolio is up nearly 1%. So I'm up $730 on a day the market is down, and the preponderance of those gains come from my investment from Williams-Sonoma. So let's jump into it. Like the video, subscribe to the channel. I'm going to show you what I'm talking about. Let's go. So as you can see here, just a completely parabolic chart on Williams-Sonoma. Currently trading for $286. It's up a lot overall time. Let's look over the last 5 years. And so you can see that I think the technical phrase for this is that the stock is mooning. That's what's happening right now. And so a small word of caution, the first time that you hear about a stock often is after it jumps up a lot in price. And so that can be a trap for new investors, but we need to figure out what these shares are worth on a per share basis. So it's trading up and down. It's trading around 284 right now, up 18% today. Let's get over to Qualtrum and do some quick quantitative analysis, and we can figure out what this company's worth. So importantly, what we can see here is Williams-Sonoma shares are trading higher after the company reported better than expected Q4 earnings, announced a new $1 billion stock repurchase authorization, and increased its quarterly dividend. So a couple notes on this. Better than expected Q4 earnings. The market doesn't respond to good or bad. The market responds to worsening or improving conditions. It's a little nuanced point, but it's important. And so they've also said that they're going to buy back $1 billion of their own stock. So there's currently $15.5 billion of stock. It doesn't mean they're going to do it tomorrow, but over an indeterminate period of time, maybe over the next year, they'll be buying back $1 billion of stock. So it is what it is. The stock price is kind of high, but the market loves this, and that's why the stock price is surging here. And so they've increased their quarterly dividend. It was at about 1.5%. The data here is going to be for last quarter, but that's immaterial because we're projecting forward cash flows, so it's close enough. But they just increased their dividend by 26%. And so this is a sort of a mid to large cap company trading at a reasonable forward PE of 17. There's a very healthy free cash flow yield of 6%. And they have a very low and safe payout ratio. So this dividend over time, I expect will get to at least 3%, in the next 5, 10, 15 years. So this as of the next dividend payout should be beating the US stock market. It should be providing a higher dividend in the market. So let's take a look at all of the different stuff we need to know to value this stock. Revenue is up and to the right, about 7% a year, getting closer to 9% a year over the last 5 years. That gets a thumbs up from me. So they're doing great on top line revenue. You always have to have that in an investment, you guys. So looking at free cash flow, it's up and to the right. And let's look over, say, the last 10 years. Okay, that'll work. This is gonna be a thumbs up. The free cash flow is up, it's around 10%, over 10 or 15 years, but in the last 5 years, it's ramping up to about 12.6 percent growth a year. So that's free cash flow. So free cash flow is moving up and to the right. That is a thumbs up from me. So these are the two of the most important things: top line revenue growth and growing free cash flow. Let's take a look at earnings per share. That can certainly move a stock. Just going crazy, up nearly 20% year on year over the last 10 years. Thumbs up for me there. All of these things are reasons why I bought this company years and years and years ago. So I checked 3 places. They don't currently have any long-term debt. They do have capital leases, but I use long-term debt when assessing the risk of a company. And so looking at the most recent quarter, they have something like $600 million in cash with no long-term debt. That's going to be a thumbs up for me as well. Looking at dividends, it's growing at 11.25% a year. That's a thumbs up because that's three or so times faster than inflation. So this is a great dividend growth story. They've never cut their dividend, and I don't anticipate that they will. Looking at shares outstanding, they buy back shares. And so what that means is they get a thumbs up, because if you bought a share 10 years ago, you now own a much higher proportional part of this company. So they're buying shares back and they're continuing that trend. So they're getting a thumbs up for not diluting shareholders. So another one, when it comes to return on capital employed, this is one of the biggest things that can drive stock performance. It's one of the reasons it's one of my top holdings. And so for the most recent quarter, they came in at 46% return on invested capital, but they've been hovering around this 40% range for return on capital employed. It's essentially the same. The same. This is probably in the top 1% of the market and one of the biggest predictors of stock price. That's why you see it mooning right now. Huge thumbs up on returns for capital. So they're able to reinvest your stock dollars profitably, basically. Now, margins are also going up and to the right. It's another huge check mark. A bottom line margin of around 13% for a retailer is absolutely fantastic. So there are no, and their shares are going down while their earnings are going up. If that makes sense to me, it means that their historical valuation, I think, is, if this data is correct, the historical valuation is um, looking good. So that would be a thumbs up. And then expenses are going up, so I'm going to give that a thumbs down just for the sake of fairness. And so let's see what we can figure out. Currently a $282 stock, $283 stock. Let's get over here and see what this $283 stock is worth on a per share basis. So what I've done is I've averaged the last 5 years of free cash flow here, and I've also put in the total cash they have on hand, no long-term debt. This is the amount of shares that they have outstanding. We saw that they're growing over the last 5 years, about 12.5% in free cash flow growth. So I projected forward free cash flow growth at 9% years 1 through 5 and 7.5% years 6 through 10. That's a very non-demanding growth of free cash flow, and it's even moving against the trend. So I'm building in some safety there. Terminal growth rate of 3%, which means that in years 11 through forever, it'll grow at the rate of the US economy. And then a discount rate of 10%, that means you need to get back 10% a year in stock price appreciation as well as in dividends. So a required rate of return of 10% for total returns. So as a $283 stock, I'm seeing a value of $239. say that overall, Williams-Sonoma is trading at or around fair value, but because of its high returns on capital employed, it's still a buy for me, and I'm really glad that I own it, and glad that you tuned into today's video. My name's Sean. This is not financial advice. Hit the like button, subscribe on the way out, and I will see you on the next one.